Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. I hope you're doing well today. And if you're new here, every Saturday we break down the latest news and the hottest topics in the world of technology and cryptocurrency over a cup of delicious coffee, espresso today. That being said, in today's episode, I'm talking about whether or not we are ready for a crypto bull run finally, Elrond news, our usual 404 Logic Not Found segment, and more. So make sure that you stick around for all the updates on this episode. And if you like crypto, please subscribe to the YouTube channel, hit the bell notification button, or you can follow the podcast on your platform of choice if you're more the audio type of person. Either way, you'll get a heads up whenever I post new episodes of Crypto Over Coffee, and I thank you for that in advance. Just a friendly reminder as well, please be aware of scammers that are in the comments posing as me and other crypto YouTubers. They are rampant on this platform, on Instagram, on Telegram. Always check the handle, make sure it's me. I don't have a WhatsApp. I'm not going to ask you to contact me. I'm not going to sell you something. So if the comment does not have the name highlighted on YouTube like you see here, it's not me, and you can report them. So please be safe out there, folks. There's scams everywhere. Now, in partnership with the folks at Keystone, I give away a Keystone tablet steel seed phrase backup in every episode by picking a random comment from the video and one Keystone hardware wallet per month as well. So just for transparency, the product is only available in select regions. So if you win and you're from an unsupported region, I'm just going to send you Bitcoin instead, which is a pretty good prize, I might add. The winner of last week's giveaway, though, for the Keystone is here on the screen. So big congratulations to you. And of course, I will be in touch. Now, since the topic of today's show, the main topic is an analysis on whether or not we are ready for the big bull run everyone's been waiting for, I'm going to kind of roll this right into the crypto market update that we do every week on the show. So after, several weeks of frankly uncomfortable and volatile crypto markets that saw Bitcoin hanging around the cusp of the 30Ks and Ether well into the 2000s, along with altcoins experiencing deep sell-offs in their own right, it's been nice to see prices rebounding big time this past week. As of the time of recording, prices have surged to 48,000 for Bitcoin, 3,200 plus for Ether, and altcoins have largely followed suit in their recoveries, quelling the fear of a long-term bear market, at least for now. The big question, though, is this. Was that the big crash that set the stage for the final blow-off-the-top bull run to end the year? Or are we just experiencing another fleeting rebound and we have a bunch of crashing left to do? Here's my take. And remember that I don't have a crystal ball. I don't have insider info. I basically know what you know. So all this will be is ever an educated guess, right? Always an educated guess. Having been through market conditions like this in the past, however, where we go from neutral sentiment to extreme fear. And when we do that in a matter of days in what everyone believes to be as a bull market, there's often then a huge opportunity in the wake of that panic to do really well. And that's when bull markets often come. These events often represent huge consolidation in the crypto markets, which set the stage for a recovery and a subsequent 180 flip in sentiment to the positive side of things. And this renewed positive sentiment is what can drive the FOMO and fervor that's necessary to drive these face-melting bull run markets like we've seen in the past. That being said, there is a lot different today than there was in 2017, for example. To name a few, there's now regulatory scrutiny and uncertainty at new levels. Institutions are investing in cryptocurrency in large volumes, and nation states are taking huge stances either for or against crypto at a national level. And these all have a different sort of effect or unique effect on market patterns that we just can't ignore. So to say that our assumptions of how things will play out based on historical data and patterns is potentially unwise to do this time around. Personally, though, I believe that we are in for a big bull market, but one that may vary slightly from the patterns of the past in terms of how long it takes to get to these all-time highs. Here's why. First of all, I do believe that the stage is set for price discovery in crypto at the end of this year, first because of the sentiment shift. We've been through several cycles now of serious extreme fear in the last few months, things that were existential, like regulatory threat, full-on bans of crypto in China, and the markets have recovered from all of them. And that shows renewed strength in the market and more maturity than we've seen before. And the presence of institutions have further stabilized the markets in that regard as well, at least in my opinion. And speaking of institutions, that's another big reason why I feel we're going to see a turn to a bull market again. Institutional demand is still running high. And a recent European survey found 62% of institutions in that survey that don't have any crypto exposure are looking to invest in it within the next year. So there's still demand and new demand coming. Demand drives bull runs, and significant demand from institutions, which then drives retail FOMO, is what drives these insane bull markets that we've seen in history. Well, minus institutions, but FOMO is what does it. I will also note that the continuing trend of supply constraints on exchanges will be a major factor here. The laws of supply and demand are still king. As more crypto moves off of exchanges and out of circulation into cold storage, into self-custody, the more heavy the effect of new buying and demand will be. So the stage is set, my friends. It's only a question of whether or not things play out the way they need to in order for a true bull market to form. There are risks to this, of course. A reversal in the supply shortages on exchanges, for example. If people decide, I'm going to exit the market, I'm going to take some profits as we approach previous all-time highs. That's possible. Or renewed regulatory firestorms that cause panic in the markets. And we'll talk more about regulatory later. We have no way to predict definitively what's going to happen, but my intuition tells me that we will see new all-time highs in many cryptocurrencies before the end of the year. That, however, should not change your risk management approach. And remember that you need to take profits and not hold till the bear market. So what do you think? That's the key. What do you think about what's going to happen? Share your predictions below for the remainder of 2021 in the comments or on Twitter if you're listening to the podcast. Now, it's been a while since we had an update on Ethereum 2.0, but we do have one piece of new news that is centered around the first significant mainnet upgrade to the Ethereum 2.0 proof-of-stake beacon chain since its launch fairly recently. The upgrade, dubbed Altair, is the first of several that will culminate in the official interoperable merge of the existing Ethereum mainnet that runs proof of work today to the new Ethereum 2.0 proof-of-stake network. The Great Merge, as it's being called, will be the first critical step in this new evolution of Ethereum into a more scalable platform for smart contract-based dApps, which is a much needed thing given the gas fees that we experience today. Anyone who's minted an NFT knows we need more scale in Ethereum. The Altair upgrade itself is going to bring significant changes to the mechanisms that govern penalties or disincentives in proof of stake, such as slashing and inactivity penalties for unresponsive or wrong-chained validators. And these penalties are driven by parameterized settings, which are modified by this Altair update. Secondly, support for light clients is being enabled, which is effectively a means by which developers can more quickly get started interacting with the network without the overhead of syncing a full node first. And so light clients basically can use another full node and allow users to interact with the blockchain without having to sync a full node. That's what you need to know in the very basic sense. Even though there are some differences in the context of ETH 2.0 consensus, light clients, in a basic sense, that's what you need to know. This is a much needed feature. There are a handful of other features also coming with Altair, but the TLDR is that this update is setting the stage for the finalization of the merge plan, which now has a formal design specification from the Ethereum community. This is going to be a big end to the year, starting with the Altair upgrade on October 27th. So we're going to have to wait and see how this goes going forward. For fans of NFTs, further reinforcement of the idea that NFTs are here to stay also came with the recent announcement from TikTok that they would be entering into the NFT space with a new feature on their platform. The hugely popular social media giant announced that TikTok Top Moments would feature NFTs derived from the most notable creators and personalities on the platform and moments therein. These NFTs will be minted on the Ethereum ecosystem through Immutable X, which is a layer 2 and NFT-focused project that I've talked about on the channel before, most specifically when I featured Gods Unchained, the awesome online game that uses NFTs and Immutable X on the show. I digress. This TikTok feature will expose NFTs and blockchain tech to its over 1 billion users and, of course, provide another platform for NFT-friendly creators to monetize their craft at some point in time. NFTs are here to stay, my friends. It's not just a trend. We're just getting started. And not all projects will succeed, but the technology will succeed long term. Now, speaking of NFTs, the Elrond network recently announced a collaboration with the IPFS storage tool Crust to serve as the fundamental storage mechanism for NFT metadata and assets on the Elrond network. For those unfamiliar, IPFS stands for Interplanetary File System, and it is a decentralized file storage mechanism that uses some similar technologies to blockchain in its core protocol. It is basically a match made in heaven for many NFT use cases, IPFS that is, allowing for decentralized storage of assets related to NFTs that live on decentralized networks. Makes sense. Crust is a platform that offers powerful tools to access the vast amount of storage available across thousands of IPFS nodes. So it's basically an abstraction of IPFS, or a service that leverages IPFS. And this service will let Elrond users log in with their MyR app, store files, and interact with the IPFS network straight through the interface. And these services will also include nice-to-have features like pinning to ensure files are highly available and live on forever, and hosting, which will let users host web content using IPFS, which makes this Elrond and Crust combo a very powerful one for Elrond and for users of Elrond. Creators of NFTs on the Elrond network will definitely benefit from these new tools, and I, for one, am excited to test them out when they are launched. Really well done here. Now, next up, folks, is today's game of Fact or FUD, where I take a piece of no good, very bad news and tell you whether it is fact or simply fear, uncertainty, and doubt. And this week, there was certainly a lot of angst around reports that stablecoins, the fiat-pegged cryptocurrencies we all use in the DeFi space, were to be regulated significantly in the United States. In fact, reports were swirling around that stablecoin issuers will be required to conform to treatment that banks conform to, which, as we know, is a significant change compared to what we have now. This is yet another story that's causing fear amongst the crypto faithful that regulation will crush crypto, considering centuries-old regulations made for banks are frankly incompatible with the mechanisms behind cryptocurrencies. We all know this, we all feel this, and I understand why people are scared about it. Now, this move is not at all surprising, though, because stablecoins are designed to act as money and are pegged to fiat currency value with various different methods. But crudely slapping banking regulations on stablecoins or money market regulations on stablecoins would be disastrous. What I can only hope for is that any regulation that is drafted is made with the technological differences in mind, such that regulators can feel that they're adequately protecting people without eroding the value of these fundamental building blocks or hamstringing crypto in general. For example, requiring each transaction to require centralized KYC AML by the issuer of the stablecoin is not compatible with how the technology works at all. Based on policymakers' performance this year, however, I have very low expectations that there will be any educated or knowledgeable regulation proposed, and this will likely have to be another battle that gets fought either in courts or in open debate, but who knows? I'll keep an open mind. I don't like this any more than you do, but in the face of inevitable regulation, which is true, it's inevitable, it should be our goal to minimize the potential damage that it could cause. So sadly, folks, this is fact, not FUD. Ladies and gentlemen, now it is time for 404 Logic Not Found, and for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this episode of Crypto Over Coffee get some attention from the algorithm robots, please hit that like button, get subscribed, hit the bell notification button, follow the podcast, whatever you can do to tell those robots that you're enjoying the content. Others might also enjoy it. It really does help the show. So thank you so much for that in advance, and a quick coffee break. Now, I cannot even believe that I have to talk about this on my show because it is so stupid that I am shocked it's ever discussed, but here we are. This week, I saw several instances of politicians and or notable government officials talking about the idea of taxing unrealized capital gains. In other words, for those who invest in an asset and have not yet sold that investment, taxing them on the gain before they've sold or realized that gain. Today, when you buy an asset, you establish a cost basis, which is equivalent to the purchase price of that asset. When you dispose of that asset, you accrue a capital gain or loss depending on the price at disposal offset by your cost basis. Of course, if that asset is worth less than what you bought it for and you sell it, you have a loss, and vice versa. You get the idea. It's pretty simple. Foundationally, when you have a capital gain, that is taxable based on a rate for long-term or short-term capital gains, depending on how long you held that asset, but you only pay that tax when you actually realize your gain and you have cash to show for it. This means that you can get yourself in a hole if you realize a gain, reinvest all that money, and then lose it all. It happens. Now, this proposed modification to the rules would mean that if you buy an asset and you establish a cost basis, and say at the end of the quarter you're in a position of capital gain, you will be taxed on that gain even if you have not disposed of that asset and realized that money or realized that gain in cash. Now, right there, you can see how absolutely stupid this is, but I will share my feelings about it anyway because it is frankly cathartic to do so. First of all, the idea here is that, okay, we're going to tax the rich. Woo, yeah, we've heard that a million times, right? And sure, I get the fact that the richest of the rich can use their unrealized gains to get other investment opportunities. It almost works like cash. But the answer to that problem is not to tax unrealized gains. It's to close that loophole. If that's the real problem, right? Solve the right problem. In reality, this would not fix this problem at all. It would instead prevent the middle class and lower class income earners from ever investing a dime in their life because they will not want to incur taxes on investments that could then quickly go belly up, leaving them owing money to the IRS without a cent to pay for it. Beyond that, what it does is disincentivize investing in the first place. When you impose taxes, you are disincentivizing a behavior with a financial penalty. People dispute that, but the sooner that we all realize that this is the truth, the sooner we'll all stop pretending that taxes are just a thing we do and no one cares and has no consequences. By taxing unrealized capital gains, the immediate result is that you crush the idea of investing for millions and millions of people who can't afford it, who don't understand it well enough, who don't have the wherewithal to track this now very complex tax structure on investments. Let's just take an example to make this very clear. Let's say you have a middle-class family. They earn around $100K a year jointly in a metropolitan area. They're doing okay. They're looking to invest in stock to grow their wealth and do more than okay. Let's say they maybe have 20,000 of stock gains in a year that they have not sold to realize the gain to cash. In that year, under this new stupid rule, they would owe taxes on that $20,000 that they've not realized in that tax year, presumably. Then let's say they pay those taxes, say that's $5,000. And then the next year there's a stock market crash and they lose that $20,000 that they had in gains. Now that family has lost big money in the market, and that's been compounded by the $5,000 they spent to pay the IRS for money that they didn't yet have. This is just unethical. Not only that, it incentivizes the wrong things. It incentivizes people to exit the market so they have cash to spend on their taxes, which is bad for the markets, making people jump out. You don't want more incentive to panic sell. We already have that. Second of all, it disincentivizes people from wanting to enter the market at all because they're so afraid to end up in a deep hole because they can't time the market appropriately. This cannot be allowed to happen, and anyone who proposes it makes me question their desire to do right by the average person. This rule would be devastating to the economy and to any average person who wants to change their financial situation through investing. It would further close the door for people to grow their wealth the right way, and it would just lock people out of the markets. We need more opportunity, not less. It is rare that I find myself at a loss for words in the face of morbid stupidity, but this is one exception. I can't believe that this type of nonsense has been mentioned as a joke, let alone as a serious idea to implement. Proposing to impose taxes on unrealized capital gains is a 404 logic not found. That I will argue with anyone. I do also want to shout out quickly, though, the long-term sponsor of Crypto Over Coffee, Ledn, who makes this show possible. Coffee and all, they keep the coffee cup full. Thank you so much to Ledn. Ledn is my go-to spot to earn interest on my Bitcoin and USDC. I passively grow my holdings with quick access to my funds if I need to withdraw them or deploy them in the market somewhere else. You get quick withdrawals, and there is fee-free trading on the platform. So if I want to buy or sell Bitcoin with USDC in that pair, I can do so right from the Ledn dashboard, which is great for times of volatility. I can move to stablecoins or move into Bitcoin as needed. Now, if you haven't tried Ledn yet, you should sign up and try it out using the link in the description box down below or on the podcast description. I'll leave a link for everyone. And of course, please do let me know what you think. And I also want to quickly mention another sort of pseudo sponsor of the show today. Really, it's a friend of mine, someone who sent me a free NFT on the Icon network. Really, really kind of them to do. This is the project or the person behind DeepPunks. It's basically using deep learning, machine learning to create generative art based off of the art style of CryptoPunks. It's available on the Craft marketplace in the Icon ecosystem. Really, to be honest with you, I hadn't used Craft before until this person sent me over an NFT. Really cool stuff. So if you can, I'll leave a link to the Craft marketplace and the DeepPunks collection and some of the other collections by this artist. Really cool stuff. Wanted to give them a shout out. So thank you so much for supporting the show. Really appreciate it. All right, folks, let's do some community Q&A now. I always answer questions from folks who watch the show, and I've got some questions from last week's episode that I'm going to answer today. And I want to remind you that if you have a question that you want answered, leave them in the comments below on YouTube, or you can tweet me at Hashoshi4 as well if you're listening to the podcast. And that being said, let's dive into these questions. Really excited. Let's do it. All right, first question of the day is from Vegans Alecco. When do you take profits if you're in the profit even during crashes? What's the strategy? So I've talked a little bit about my profit-taking strategy in crypto on the channel before, and I generally set thresholds for myself in terms of gains. So if I buy an asset and I establish my cost basis, I basically say, I'm going to take X percentage of my total holdings in profit once I hit a profit percentage of X, Y, or Z. So let's say my first profit taking might occur after I've made a 15% gain. If I've made a 15% gain on my underlying investment, I might take up 10% of my principal off the table. And these are just examples, right? It's really dependent to me on how I evaluate risk on an asset. Really, really risky altcoins. Like if I were investing in Dogecoin, which I have done before, where I bought it to make a play because I had a feeling it was going to go up, I will take way more off the table way quicker than I would with an asset that I really, truly believe in long-term. Something that I believe is a long-term asset. Dogecoin is a short-term asset for me. It's a short-term profit play. Highly risky, so I want to take my profits off the table quick if I've got them, right? So really it starts with that. I evaluate how much risk that I have on the table. And during a crash, during a period where I might be in profit during a period of crash, like we have been in the last several weeks, to be honest with you, the way I approach it there is I try and determine if I believe that this asset is going to make a big recovery when the market recovers. If that's the case, sometimes I will roll profits from that I've taken before the crash, and I will roll it into that asset and double down on it instead of taking profits during a time when prices are very low. Again, that introduces significant risk, so you have to be careful doing that. But general rule of thumb, set yourself thresholds. We'll use a simple example, right? Let's just say you invested in Bitcoin and you invested at 42,000 during the crash. If you could say, when Bitcoin hits 50K, I'm taking my principal off the table. I'm taking profit. Easy, right? Because then you're playing with house money in a way. You've got your principal off the table. From there, you might say if it goes to 52,000 or goes to 55,000, I'm going to take another 25% off the table. The rest is going to be a long-term sort of moon bag, as people call it. That's the approach that I usually take. And I take more off the table, the more risky I think the investment is that I've made. That's my general strategy. And of course, there are times where I make ad hoc adjustments to my strategy, but generally speaking, I like to stick to it. I make a plan up front. I decide here's the points where I'm going to start taking money off the table, and I stick to it. I don't second guess myself. And if I miss new gains, I don't spend any time worrying about it because there's always new opportunities. People get in trouble when they start thinking, oh, well, this YouTuber said that this coin's going to 10x in the next couple weeks, or in the next month, or in October, or November. And then you hold on to something and you're exposed to all this risk and volatility when you had profits in the first place, and then you end up holding it to a huge crash and then you're in the red. That's not the way to go. Some people do it. I don't recommend it. So don't focus on being greedy and trying to get the most profits you can. You can be responsible. You can take profits and still have some exposure for that long-term chance of a random 10x, right? So just be careful, have a plan, stick to it, make setups and make sure you stick to them. Simple as that. Thank you for your question. Second question is from KWY0220. Could you share some information about your story as a developer in the blockchain space and some tips for people looking to get started in this industry? Can do. So I didn't have a super formal computer science education. I went to school and I did get a bachelor's of science, and I did it across, it was sort of like a multidisciplinary major where it was very focused on business and economics, and it was not a minor, it was almost like a dual major with computer science. That's how I would describe it. And so I got a lot of very wide breadth of knowledge and not a lot of really deep depth. And so I didn't have the same, I didn't have an MIT computer science education, is I think my main point. My interest in computer science started as a kid because that's what my dad did for a living. And so when I was in college, at that time, there were plenty of ways that I could tinker and play around and learn things on my own. And so I was doing that in the blockchain space then because that's what I was always interested in. I wasn't sure if I would ever have a chance to work on it full time because quite frankly, I didn't know that it was going to have staying power with anyone but nerds like me. I was wrong, and I'm glad I was wrong. When Ethereum came into the mix, it was a perfect opportunity for me to actually start tinkering and building cool things because, of course, Bitcoin, there were ways to do it. I wasn't that sharp with C languages in general, and C++ just wasn't my thing. So it was tough for me to really do much in the Bitcoin space. When Ethereum came, Solidity was something that I was able to pick up. It's very easy to learn, very hard to master is the way I always describe it. But I was able to tinker and learn and play around and build things. And I ended up parlaying that learning, my self-taught learning and Solidity, into a full-time gig doing that and building things, right? A lot of it was proof of concepts. It was test applications. It took a while before I started getting things into a place where I was comfortable putting into production. And still to this day, I have these nightmares about writing something. You don't know what you don't know. You're not perfect. You might go through an audit and that audit might not be perfect. And I always had this fear something that I wrote is going to cause a problem. To this point, there was never a huge financial loss. I've made mistakes, at least for something that I wrote. So there's the stories. My recommendations for people that are looking to get started is just to get started. You can do what I did and you can teach yourself this stuff. And then once you do that, you need to find mentors who can help you level up and learn and get better and learn from mistakes. But the only way, in my opinion, to do this is to just start doing it and to make those mistakes, have people to tell you that's not the way you're supposed to do it. That's the only way. You can get in this sort of trap of continuously trying to learn new stuff and read this article, subscribe to this on Hacker Noon, watch this YouTube video, do this and that, and you're never actually building something, you're just watching other people do it. You're not learning anything from doing that because you can't sit down and do it on your own. That's my recommendation. Pick stuff up, start trying to clone and understand, not just clone, understand the fundamental logic behind other projects that you've seen. The cool thing about the blockchain space is almost everything is open source and not everything is well commented or documented, but go into the channels and say, hey, I see your code. Do you have 10 minutes to explain this line to me or this function to me that I don't understand? You'd be very surprised at how much information you can get from people in the crypto space and in the blockchain space that are just going to donate time to you to help you. That's my recommendation. If you want to start learning Solidity, which I think still to this day is probably the most rewarding language to learn because there's a lot of opportunities, start with cryptozombies.io. If you don't have any coding knowledge whatsoever, start with some fundamentals. You can start with JavaScript, you can start with Python, do a computer science 101 class online, understand some of the fundamental components of it and the theory behind computer science and programming. And there you go. Honestly, it's just a matter of doing it and working and testing things and failing very often. You will spend more time with code that doesn't work or that behaves badly or that is written very poorly than you will with high quality code for at least the first year, maybe 2 years that you do this. And that is okay. That is normal. And don't let anyone tell you, oh, you're not good enough, because you are. You can. Everyone can learn it. Doesn't matter if you're a math brain person. Anyone can do this. It's like learning a new language. It can be done. So get started. If you have any questions, I'll do my best to answer them. And if not, I can help connect you with other people who can. Thank you for your question. Question from Bad Carol. You advertise VPNs a lot. What is the actual palpable benefit of using a VPN? Is it that easy to identify wallet addresses by analyzing internet traffic? So yes, I do talk about VPNs a lot. I do also like decentralized VPNs. However, performance-wise, they're often not that great. So decentralized VPNs are not great for everyone. For some people, they are. For other people, they're not. For me, I understand how to use them. I know the limitations. Great. For others, you want a VPN that's just easy to use, so I recommend existing VPNs. That's one thing up front. The tangible benefit of using a VPN is a few things. First of all, a lot of people are on poorly secured internet. Let's be real. They're on access points in public. They're on access points even in their home that's configured by, I'm sorry to say, a goof who doesn't know what they're doing. There's a lot of risk in doing that because you could have situations where your traffic isn't encrypted. If you're on Starbucks Wi-Fi, it's very likely you're in an unsecured channel. You're just exposing everything to anyone else that's on that network with any savvy, right? That's the problem. A VPN establishes a modicum of encryption to your traffic. That's the number one thing. It isn't perfect, but it is pretty good. The second thing that it does is it provides you obfuscation for your IP address generally for that traffic. There are many reasons why you might want to do that. When you're logging into a certain service, crypto or not, you might not want the same IP address, your home IP address that you use that maps to your home address, because it does. You maybe don't want that exposed, right? And a VPN provides you obfuscation to the end server, the end point that you're trying to reach to. The client that they see is a different IP address because your VPN server is acting as a proxy for you. Those are the two tangible benefits up front. There are more of them, right? It allows you to move countries. There are some times where I'm interacting with a particular service and I need to test something, right? Let's say I'm working on an application and I want to test how this is going to respond to traffic from a different country. I use it as a developer all the time to test that type of thing. There are lots of interesting things that you can do with a VPN, but at the base level, you're looking at encryption and IP address obfuscation. Those two things are used very often, particularly for people in public places. Those are just two things you might as well protect. It doesn't cost that much. People are like, oh, why would I waste my money on a VPN? Okay, well, a VPN maybe costs you $30 a year if you buy something cheap and good quality. And no, they're not perfect. It's not a silver bullet for privacy and security. I've never branded it as such. Others do. That's not my thing. It's not. There are 100 other things you have to do to make sure your privacy and security is solid online. And a VPN is only like a small portion of that. But it's a good best practice to get in the habit of, just to make sure that you're enforcing encryption and IP obfuscation. So that's my answer. Thanks, Bad Carol. And the last question is from Arco Ghosh. How do you think the partnership between Cardano and Chainlink will affect the two? I don't really think it's going to be that heavy of an effect, to be honest. Chainlink is partnering with virtually every layer one chain. That's their strategy. They are trying to be the Oracle provider for everyone. Not surprising, totally fine. I think what's going to be beneficial is that the heterogeneity of oracles in a protocol, so the availability of Chainlink plus locally built oracles like Charlie 3, however you want to pronounce it, that'll be good for Cardano, right? The more oracle options that you have allows for dApp aggregation opportunities to aggregate data from multiple oracles for high reliability or more reliability around the data that you're getting, being sure that you can be confident in that data. There's a lot of tangible benefits of having a variety of oracles in place. For Chainlink, the benefit is you get a huge community of people that are willing to interact with dApps and spend a lot of ADA that subsequently feeds the Chainlink ecosystem. Chainlink thrives when people use the platform. And by integrating with Cardano, they're betting that lots of people will use the platform. That's just the truth. So I think the tangible benefit for both is adoption. It is a mutually beneficial partnership to bring technology to Cardano that it needs. Cardano provides the users that feed that ecosystem. That ecosystem provides data, which feeds dApps. You get this nice flywheel and everyone wins. That's the idea. So I wouldn't read too much into it. A lot of people look at partnerships and they're like, oh, well, what's hidden underneath the covers? This is a pretty straightforward partnership, in my opinion. So there's my thoughts. Thank you so much for all the questions. Please keep them coming. Love answering your questions. And of course, thank you so much for spending the time watching Crypto Over Coffee. It's an amazing show that is only made possible by you. If you have time to stick around, please do check out my top 3 VPN picks video. Like I mentioned in one of the Q&A sessions, I believe it's a great, cheap, and easy way to up your game on your internet security and privacy. Not a silver bullet, but a good start. Check out the video if you're interested. Thank you so much for watching Crypto Over Coffee. Thank you for listening to the podcast version if that's what you're doing. And until next time, thank you so much and cheers.